Hi, I'm Roger Conrad. I'm editor of Canadian Edge. What I want to talk to you about today is the subject we've been discussing in Maple Leaf Memo. We'll also be discussing in the June issue of Canadian Edge, and that is the interest rate increase in Canada. Now, a lot of people have been confused about what this exactly means, whether it's is it bearish for income stocks, like so many people have been trained to expect, or what can we expect out of there? And I think basically this is a bullish event. While that may seem counterintuitive, let me explain why. First of all, the reason that Canada is abandoning the quantitative easing that all the other major governments of the world are continuing to do to prop up their economies is because the Canadian economy is very strong. The last GDP numbers we saw annualized growth of 6.1%. That's extremely explosive. That's roughly twice the rate of growth in this country, many times the rate of growth in some of the European nations, which are really mired in recession. It's a really great sign of robustness for Canada. Along with that figure came an uptick in inflation to an annualized rate of 1.8%. That's still below the Bank of Canada's 2% target. But by taking this step with interest rates, they are signaling that they will keep that under control. Now, when the Canadian government or Canada or any country really increases interest rates, it's also very bullish for its currency, particularly against countries that are continuing to slash rates to really keep things going. So this is a very bullish event for the loonie, which has backed off against the US dollar since the flash crash of last month. And is now has gone from parity back to the 94-95 cent range. But I think this interest rate increase signals that we're going to see more strength in the loonie, probably sooner rather than later, and that will again push us up towards parity. Now, of course, what that means for our Canadian investments is a higher US dollar value of the share price, so a nice capital gain there. Also, a higher US dollar value for our distributions, for our dividends. So, in effect, a dividend increase coming from that. So, again, very, very bullish. Now, if you want to look at individual businesses, some could be hurt by higher borrowing costs. We've already seen an increase in mortgage rates, and that could hurt entities like Brookfield Properties, which rely on real estate transactions from the network of real estate agents that they have across Canada. So to the extent that that depresses sales and home sales and so forth and commissions, that will hurt them. On the other hand, you know, if you look down the list of Canadian companies, and we do so in the June issue of our portfolio companies, you look down the leverage situation. There's not a lot of refinancing risk here. There's not a lot of leverage risk with these interest rates. A lot of our companies are focusing on growing within their means, within their cash flows. So a small uptick in interest rates, not a real big deal there. Also, you know, and again, a lot of investors are trained to believe that or to react as though when interest rates rise, it's bad for income investments. Keep in mind that we've had really pretty much a 2-year decoupling of benchmark interest rates like the Treasury, like the Canadian Treasury, to the prices and yields of other income investments. And in fact, when interest rates have risen, when benchmark interest rates have risen, we've actually seen some huge rallies in other income investments. And when benchmark rates have fallen, we've seen sell-offs in other income investments. The reason is benchmark interest rates and income investments are responding to the economy, not so much to inflation, but to the level of economic growth, to the threat of a recession. And anytime the economic news is bad, benchmark interest rates will decline, and so will the prices of other income investments. When the economic news is good, on the other hand, benchmark interest rates may rise, and the other investments may rally, and in fact rally very strongly. So that's the kind of market we're living in right now. So therefore, put all this together, stronger loonie, the fact that this interest rate increase signals a very strong Canadian economy, also what it does for our investments, our US dollar value of our investments, and then finally the fact that you know, these companies are really not that leveraged to those benchmark interest rates, either as businesses or as stocks. And I think you've got a very bullish picture here. So I think that's what's going to sort out from this interest rate increase. And again, very, very positive on Canada. It's the strongest of the G7 countries, and one of the, and in fact, really earning the moniker Northern Tiger for its ability to really come out of this last recession in a very strong way. So again, this is something to be positive about rather than negative. Thanks for tuning in. I'll look forward to chatting with you next time.